Welcome back to the Guaranteed Retirement Guys show. So today I want to talk to you about the annuity formula, how to calculate present value as well as future values. All right, so let's take a look at exactly how this would work as far as if you're putting your money into an annuity and you want it to grow over time. And you also, maybe 10, 15 years from now, you might turn it on for income, or maybe you'll just take the money out. So there's a couple different strategies that you can use. Fixed index annuities you can use for income. They're tied to an index, and whatever that index earns, you earn. And of course, if the index loses money, if the market is tanking, then you're guaranteed not to lose a dime, which of course, I love, and I'm always an advocate for fixed index annuities because I love being able to have the opportunity to grow with the market, but also have the opportunity to not lose anything when the market tanks. On the flip side, when you have a fixed annuity, a slight difference between a fixed and a fixed index. A fixed annuity is fixed. It's like a CD. You get 4 or 5% or whatever it is, and that's fixed, and that will accumulate over time. And so with that, it's very guaranteed. It just shows you, hey, it is whatever the contract says it is. So if it's 4%, that's what you get every year. It doesn't matter if the market's going crazy high. You don't get any of that. You do not get any of what the market gives you. You just get whatever the fixed annuity, or what we call a MYGA, or a multi-year guaranteed annuity. That's what you get. Okay, so I'm going to show you, I'm going to actually pull up my computer here, and I want to show you what this will look like. So let's come over here. I want you to actually see what this would look like. So I just plugged in my name, and even though I am a little bit younger than 60, I will be 60 someday, and of course I'm married, so I'm going to put my age here. I'm actually going to put my age at 62, because when I'm 62, my wife will be 58, so she is 4 years younger than me. And I'm just going to play with a simple $200,000 premium, okay? And you can see I have access to a lot of different companies here. I like to look at A-rated. You'll see some B++ companies in here. Not bad, but typically if you're looking for an annuity, you want as high of a rating as you can possibly get from a company. Okay, so I'm going to take a look at the American Equity, and let's just use this as an example. So you'll notice that $200,000 in, I have this scrolled out for 10 years, but let's say I don't want to wait 10 years to take income. So 62 years old, I want to take income at 67, okay? And in this example, maybe I want to wait till my Social Security age, because my full retirement age for Social Security is 67. So it would make sense that maybe I'll turn on this income at 67 as well. I mean, you can do it completely different for yourself. I mean, some people use annuities to bridge the income gap that they experience at their retirement age between where they want to take Social Security. You might want to take Social Security at 70, which is not bad if you're looking to maximize it, or if you want higher benefits for survivor, maybe for your spouse. That's a great plan. And then you might use an annuity to kind of bridge the gap in between, so you can still retire early, enjoy the good life, but also be able to defer, wait taking your Social Security because you want it to be higher. Okay, so that's what I'm going to do. In this case, my case is I'm 62 years old. My wife, Holly, she's 58, and we want to retire right now. Okay, maybe I don't want to take Social Security for another 5 years, and because of that, I don't really want to take any income for 5 years from my annuity. Okay, so what I'm doing is I'm putting $200,000 in it, and you can see from the screen here, I brought this out 5 years. So I'm deferring joint income for 5 years. So I'm going to start receiving it at 67. My wife will get it at 63. And you can kind of see which ones are kind of floating to the top here. So AIG, 18,125, not bad. American Equity, 17,837. But let's say I just end up, for some reason I like this one, or maybe I like this one. So I'm just going to pick one of these. So enhanced payments, I want a little bit higher. Enhanced payments, by the way, is usually they'll get close to, sometimes they will double your income if you need it for like long-term care. Sometimes it's not doubled all the way, but it gets pretty close. So let's just look here at American Equity. Okay, so this is a great example of what this looks like. So the one I pulled up was an 8.25% roll-up. Okay, so we're talking about calculating present and future values of the annuity. Well, present value is, like, for instance, if I put this in an American Equity right now is giving me a 10% bonus. So my present value will actually be 220. Okay, so they're showing me guaranteed versus non-guaranteed. Guaranteed just shows if the stock market, or if the index does nothing, you earn nothing. The income never changes. The income's always there. So let's look at the hypothetical, and the reason why is because it's more realistic. Believe it or not, hypothetical is more realistic because it's used to the index. It's taking into account the index growing, right? And when the index is growing and you're making money, then your account is doing great. But you'll notice in this one, it does not affect the income, just the account balance. So, anyways, this is still a more it's a more real picture of what these growth rates really look like. So for this present value, a real present value for this one would be $220,000 plus any index earnings. So you can see at this point, if it earns 3.24%, your account value is $224,000. Go right back up to the guaranteed. The worst case scenario is if it earned nothing, your account value is only $217, because remember, they took out a fee, which is a little over 1%. Okay, so keep that in mind. That's the income rider fee. That's how they guaranteed this income. If I live to 91, they're going to guarantee $445,000 out of my $200,000 investment. So not bad. And of course, if I die and Holly keeps living, she just continues to get the income. So that's the beautiful thing about this. Okay, so let's take a look at this. You can see how to compute future values is just multiplying the interest rate by whatever the account value is. So you can see at $220,000, right? It earned a 3.24. Not a huge amount, but it brought the account value roughly up to 224 after fees. Okay, remember that the fees, minus the fees. What were the fees on this one? Roughly 1.2. Okay, so 1.2%. All right, so we'll go back here and we'll say, okay, so it's 224 minus the fees plus the interest credited, okay? Next year, maybe it did a little bit better, okay? It earned 4.23%. It's now worth $230,000, okay? Pretty good. But, a couple years after that, pretty dismal, didn't hardly earn a thing. So, it earned a little bit, just enough to barely cover some of the fees. And then you had a year where it went up like 5% minus the fees. It's worth like $235. Okay. Return on the income, 17,837, right? But that income is not based off of $235,000 account value. Okay. So we've already basically computed the present value of this annuity based off of what the index hypothetically has been doing. Okay. This is based off of what it's done in the past. Probably will do something similar in the future. Okay. But even if it doesn't, you'll notice, and I'll just go right back to this, it's giving you an 8.25% roll-up. Okay. Let me explain how that works. That's contractual, and that is for the income value of the account. So let's go back in here and you'll see the income base account here. It's actually worth a lot more, $238,000 versus $224. People ask, well, why is that? Well, it's because they're multiplying an 8.25% roll-up rate. So they're multiplying your account value by times the 8.25%. And that is what's giving you that income base of $238,000. What's nice is they do that every year. So you see the second year is now worth $256, now $274, now $292. And then, at the end of 5 years, it's now worth $310,000. That is the real value of the income base. Okay. So that is how they calculate the income. And so when you're looking at an annuity and you want present value, well, if you want present value, it's basically you're funded an annuity right now and you're looking at taking income immediately. Maybe it's a SPIA, okay, single premium, annuity. Maybe you're looking for something that gives you immediate income, and the value is what it is. It's whatever you put it in right there at the beginning. Okay. Now for future value, it's hard to know with an index annuity what the future value of the actual real account balance is going to be, because we don't know what the index is going to do, right? We can't really tell you what the stock market or where the index is going to go. So we can just look at hypothetical numbers, and we know based off of hypothetical numbers where it'll probably land. Just like anyone will look at the stock market and say, well, it's earned this much over this period of time. It'll probably be worth this after this period of time. Okay. Whether or not that's true remains to be seen. Here's what I like about index annuities. They give you a guaranteed roll-up rate. This guaranteed roll-up rate is, well, it's guaranteed, right? So it's guaranteed at 8.25% of this one. And so they do not care what the index is doing. The index can earn 0, 0, 0, because if you notice, this is worth $310,750 after 5 years. Let's go back up to the guaranteed. And you notice here, it is worth exactly the same, $310,750. So it shows even if the stock market, even if the index does nothing, and you earn nothing, and your account balance is eaten away by fees, you can see it basically is eaten away practically down to the amount that you put into it in the beginning, the 203, doesn't matter. Because you'll notice that the income value, that's what matters. Because you're earning an 8.25% every single year. And then what happens is at the end of that, let's say, and I'm just saying in this scenario, 5 years for myself, I want to retire at 67, my wife's going to be 63. We're basically going to take out our income at, it'll be $310,750 multiplied by the 5.74% lifetime withdrawal rate. Okay, if I were to wait longer, both of those numbers rise. I'll just show you that real quick so you can see. So we decide, hey, you know what? We're going to wait till 70. We're going to wait till 70 because I want to maximize my Social Security, right? I want to have the most I could possibly get. And so I might, I'm just going to drag this out here. 8 years. All right. So now I'm starting to receive income at contract year 9. Okay. At age 70, my wife, Holly, will be 66. So looking at this, you'll notice American Equity, the longer you keep it, it usually will beat out AIG. But not always. They kind of flip-flop sometimes. Sometimes North American will come in there. You can see North American down here at the bottom. They're not bad. They're right in the running. So if you look here, though, I'm just going to show you what this looks like. Just so we can kind of compare. I want you to see how the roll-up rate, as we are computing future value of our annuity, if it's an 8.25% roll-up, then I want to compute my present value. If I was to take it right now, well, I don't really have a roll-up rate that's touching it. And if the index doesn't have a chance to earn anything, and I just take income immediately, then it is what it is. But most of the time, people will fund their annuities and start taking income 2, 3, 4, 5 years or later. And that allows their roll-up rate to work for them. Okay, so let's look at this. Go back to the screen here, and we'll see. Originally, remember, I was looking at a, let's see, a 300 and, let's see, this was 308 times 5.74, and then you can see if I wait till I'm 70, now the roll-up rate has increased the account value to $378,000, and my lifetime withdrawal rate has also risen to 6.17. Okay, which of course is giving me that guaranteed income now of $23,323, and of course if I take that out until I'm 91, that is $513,000, which Holly at that point will probably be 87. She's probably going to live at least another 5 to 10 more years, just because there's longevity in her family. So she's going to take out probably another $150,000. So I wouldn't be surprised if out of this $200,000 we take out $650,000. I would say $650,000 is probably what we'll take out of. So pretty good. But that's how you calculate the present value of an index annuity, something that's giving you income later on based on a roll-up rate. Okay, and that roll-up rate is contractual. It stays the same. Now, let's say I am someone that does not want income, okay? Maybe I just want a place to park my money. Great. Probably a fixed index annuity. I mean, unless I want more access to more growth, index growth, then it's still a great place to put my money, even if I don't need it for income. I can still leave it for my beneficiaries later on. But if I just want a place to park my money versus just a bank account, but I want something that will give me a guaranteed amount no matter what, I'm okay with not having what the index makes. If the index makes 10%, it doesn't bother me that I'm only making 4%, right? So in that case, I would probably look at a MYGA, a multi-year guaranteed annuity. Okay, these are called fixed annuities. Very similar to fixed index. Okay, the only difference is it's not an index. It's a fixed rate. Okay, so let's take a look at that. So I'm going to go right back to my profile here. And again, we want to calculate present and future value of my annuity. Okay, so I'm going to go into here. And let's see, top MIGAs. So I'm going to at least A-, right? And let's say I want to look at, I'm going to narrow this down, 5, 7, and 10-year annuity. And let's say I want to put in $250,000. Okay. $250,000. We've got a 5-year, a 7-year, and a 10-year. So we can kind of see here, all right, the 10-year is the Annuity. That's the top one right now, at least as of this recording. And it's paying a 5.45. Not bad. Way better than it was a few years ago. So obviously no guarantee what it's going to be next year, but this will at least give you an idea. So we've got the American National or Annuity at a 5.45, and then you've got Clear Spring and Oxford, which are close second and thirds. But again, when you look at total growth, I mean, they're both lagging behind by about $20,000. Okay, so let's look at the 7-year. Again, Annuity is beating everyone again, but this time the second best for a 7-year is Americo and Athene. Okay, they're giving you a little bit more, 5.25, 5.2, but you can see they're still lagging. I mean, instead of 362, they're 357, 356. So, roughly $5,000 less in growth. Okay, and then let's look at the 5-year. Athene now is beating Annuity. So, well, no, they're not. They're about the same. Okay, 320. Well, they're all the same. Okay, look at that. So Athene, Annuity, Americo, they're all making 5.1. Well, there you go. So you can just pick. Some people like to diversify, and they'll just put their money in each one, just to kind of spread their assets out. So I want to go to the 10-year, though. Okay, so I'm going to look at here. I'm going to show you. I'm just going to illustrate this for you because it's so much easier just visually showing you what this 5.45 is doing for us. Now, and I love this. I've sold a few of these because they're so popular right now. With interest rates being as high as they are, it's great. Okay, so let's see. Let's bring this back. $250,000. Fix my age. I'm 62. Doesn't, non-qualified or qualified, you can do whatever you want. You can transfer from an IRA into an IRA. We can do that, sure. It doesn't have to be, though. Nevada. Okay, and you can see they do have lower rates here, actually, if you pick the 3-year and the 5-year. See what the rates are here, 5.2, 5.1, and then the 3-year is a 4.45. So it definitely pays to take advantage of longer term rates. So you can see 5.45, 10-year. Let's see what that looks like. I love this. Just a beautiful green line. So we can see every year money just being dropped in that account. And guaranteed ending value from $250 is $425,000. So go down here, we can see exactly what it looks like. We can see earnings, 13.6, 14.3, 15.1, almost 16, 16.8. And you can just see that thing just grows. That 5.45 is working for you every single year. So MIGAs are pretty simple. They're pretty easy to understand. You're just basically multiplying the rate that you're earning by the current account value. Okay, and that account value, of course, rises every single year. And so that 5.45 is multiplied by that current value after the prior earnings were added to the account, which is nice. So have that compounding effect. There are some annuities out there that only pay you simple interest, and they'll give you like a 6 or a 7, and they sound or they look good. But in the end, their guaranteed yield to surrender is way lower than some of these compound interests that are lower off the bat, as versus 5.45 versus a 6.2 or a 7.2. So a lot of times they do that as a teaser to get you in. And if you're not wise and you can't tell the difference between a simple interest or a compound interest, then you get sucked into something that's not so great. So anyways, total ending value, you can see $425,000. your $250,000 earned $175,000. Not bad, right? That's what I'm talking about. So if you're looking for guarantees, MYGAs are great. Okay, multi-year guaranteed annuities work well for guarantees. It's just for lazy money, though. It's for money you don't need for income. Okay, you could take some out. Sometimes these will allow you to take, up to 10% out every year. You can just kind of live off the interest. But if you're going to do that and you need it for income, I highly, highly recommend a fixed index annuity instead of a fixed. An index annuity will give you the index. The index will give you whatever it earns, okay, which is terrific, especially when the market is roaring. You want that. But at the same time, what I like even more about index annuities is you have the roll-up rates, which are a lot of times 7% or 8% or even 9%. It really depends on the annuity company. Now, a lot of other factors come into play. You have these roll-up rates that are used to multiply and create value in your income account value. But at the same time, different annuity companies have different withdrawal rates that they use to multiply against that income base. So remember that. That's why you need to talk to an annuity specialist like me, okay? Someone who looks at all of the annuities, someone who has your best interest in heart. Okay, I don't care what annuity you pick. It really doesn't matter to me. Okay, I'm not beholden to any annuity company, even though they will come into my office and they say, hey, John, sell this and we'll give you another 1 or 2% commission. It's going to be great. And the problem is I can't look my client in the eye and say that's the best thing for them when I know that there's something over here that might be better but pays me less commission, right? Not cool. Okay, you're looking for the best thing for yourself, and it's not for me. I'm not looking for me. I'm looking for you. Okay, so happy to do that for you. If you want me to look at an index annuity and project some future values, let me do that for you. If you're looking for just a MYGA, a multi-year guaranteed annuity, something that you can just park money, I'm happy to do that too. I sell those all day long, and I can show you the best ones out there. So that's it for today. I hope you enjoyed it, and we will see you next time.